I would say work as hard, if not harder, multiplying your money as you do earning your money, because once you have a little bit of cash, it's so much easier to grow.
That's interesting because I had gone through the masterclass that you had put forth, and it was very eye-opening for me to actually understand this perspective. Because when we look at this clean energy and we look at especially like electric vehicles, we recently bought an electric vehicle. The fact that you still require fossil fuels to actually get those electric vehicles on the road and keep them running, it was very eye-opening because on the one hand, we're talking about cleaner engines and cleaner fuels, but on the other hand, essentially we're just shifting fossil fuels from burning in one type of vehicle to another type of vehicle. And that was very, very eye-opening for me. But in terms of investing in this per se, right? Obviously, the US is not the largest producer of fossil fuels in the world. Do you primarily focus on investing only in the US, or do you look at the global scale of production? And how do you see the US actually playing a role in the larger scheme of things globally?
Yeah, well, it's actually great you bring that up because most people don't realize that the US actually is the largest oil producer in the world. That's
Oh,
what's crazy
really?
about
Interesting.
this. Yeah, we are. And, that might not be for the future if we don't continue to invest in new production. The Middle East is obviously, that's been a big part of what they do. Saudi Arabia is sitting on massive amounts of oil. Russia is actually a pretty big producer of oil and natural gas. But it's actually surprising. We have all the resources in the U.S. that we need to meet all of our needs and to even export. That's what's so fascinating about it is the narrative is just so one-sided. And again, not to get political, but from an investment standpoint, I love it because there's these really clear facts that you can't argue with, right? And whatever side of the fence you're on politically, it doesn't really matter. I'm looking at these things from a pure investment standpoint, right? And maybe if you have, a moral issue with fossil fuels, that's a different thing. And I actually there's a great book called The Moral Case for Fossil Fuels. I encourage people to read because it actually, there's a whole side of this that's actually very, very beneficial to global human flourishing. Cheap energy has been the single primary factor that has driven most countries that have been, undeveloped to developed. Having access to cheap energy is essential to having these countries get out of poverty and to improve just human flourishing in general. And if you actually look at, global warming is one thing. Yes, we have increased our carbon footprint. But if you look at, the other side of this, which is, deaths caused by, natural disasters and deaths caused by other things that you would think would be a consequence of global warming, have exponentially dropped because we're advancing as a human civilization, not just in the US, but across the world. And we can actually manage, these issues in a better way because we have more advanced technologies. And it's also up for debate with whether, higher carbon is actually okay for the environment because, what's the primary source of food for plants, right? They like carbon. And so we've actually seen an expansion of the foliage and green, trees, bushes, all those kind of things across the world since we've done that. So there's a lot of things we don't know, and we have to be smart about it. We want to make sure we're not being stupid and utilizing all the resources we have. But to go a little bit into an aside on that, I think it's important for people to really dig past just the narratives. And then going back to the investment side of this, if you look at, I want to invest where there's value. I want to invest where there's kind of inherent opportunity. And one of the greatest value investors of all time is Warren Buffett, right? And he's kind of considered, one of the fathers of value investing. And he's making huge bets in oil right now because he sees this declining supply curve, right? And it's inelastic. It's not something all of a sudden we just decide to flip the switch and we can just produce more oil because there's this long time frame that leads up to got to go explore it, got to go test it, got to go get the permitting, got to do the drilling, and got to build the capacity. Got to have capital flows there. And so the supply is decreasing, and demand, meanwhile, is projected to be at least the same, if not higher, over the next decade. Well, if you understand economics at all and supply and demand curves, that's a pretty good recipe for, strong oil prices over the next at least decade. And then you add to the fact of this, so that's kind of just the price environment, but then you add to the fact because of a lot of the ESG initiatives that are being forced on a lot of big capital allocators like the Blackstones of the world, they're actually required to invest large portions of their portfolios into green energy. Hey, again, that's a great thing. I'm not, demeaning that at all. But what's happened again is that investment into fossil fuels has dramatically reduced. So private equity funding has kind of left the landscape, by and large. And so it's actually created less competition for really good quality basins, really good quality operators. And we're buying cash flows, existing properties that are existing cash flow with all the decline and depletion curves built in, usually around 20% present value. And so if you understand real estate, that's basically the same as a cap rate, right? We're buying these at 20% cap rates, right? I mean, it's kind of hard to imagine because it's so different than,
Wow.
real estate from a cash flow standpoint. But there's just a lot of value there. There's not as much competition. You can buy these at really good values, and you can have upside through new drilling. And if there's price appreciation, which we think the probabilities are to that side of it, that's only upside, right? So it's a really great time again where we think
Right.
right now where it's this kind of perfect storm of reducing supply, steady demand, not as much competition, and you can buy really good cash flows to reduce your risk in these types of investments.
So, I think what you're saying makes so much sense to me, but, coming from a real estate kind of the industry, focusing on multifamily, I understand the numbers, I understand how multifamily works. But say, for example, somebody wants to invest in oil and gas, right? What are the things that an investor should really look at before they even start investing? Because you need to do your due diligence, right? You need to understand the numbers. You need to understand how the industry works. So really, what do you think they need to look for or look out for, watch out for when they're investing in oil and gas?
Yeah, I'm so glad you brought that up because it's one thing to talk about the macro, right? And the macro is a lot of times the fun part, but the micro of, okay, how do you translate? If you believe the thesis that I just laid out, then how do I actually invest wisely in this asset class? And that honestly is the biggest challenge because there are bad actors. There's bad actors in every, investment class, but for some reason, oil and gas, it can attract just some people that aren't doing the right thing. And so, this is again where you really want to work with the right partners, the right operators. But even aside from just doing the basic due diligence on the right, partners with their good track records, you want to also understand the strategy that you're investing in, right? Because there's kind of a few different strategies, and in simple terms, there's working interest, you have mineral interests, you have non-operated, you have operated. And those are kind of one layer of it. The other layer of it is what type of program is this? And I've seen a lot of people, as they get excited about oil and gas, they invest in what I call kind of pure drill program plays. And what that is these are sponsors raising money to go and drill a well, a couple wells. And, it can be either wildcatting, which is more exploratory, much higher risk, or it can even be infill, which is lower risk. It's, here's a basin that we're drilling in. They've already drilled a lot of wells, and we're going to kind of drill another one where we think there's oil in the same basin. Lower risk, but you still have the risk of hitting dry holes, right? So the biggest risks here are your operators, not running a Ponzi scheme, and then two, hitting dry holes. And so what happens, what I've seen a lot of people do is like, hey, I liked oil and gas, I invested, but I actually lost some money, even though I got the great tax benefits. But they didn't realize what they're investing in. They're investing in, say, one or two wells. If one of those wells doesn't work, all of a sudden your return goes from really, really good to pretty abysmal. And if neither of them work, it goes to a zero, right? And so you just lost money. And so what we're doing, we think the sweet spot is because of the value that you can purchase existing cash flow at. We're going and buying existing cash flows of existing properties. So for example, we just closed on a property, has 143 wells that are producing. These are horizontal wells, so these are, institutional type wells that are, very high quality. And it's in one of the best basins in the Scoop Stack Basin here in the U.S. And these are producing, and you can run all of the engineering and the decline curves of here's, as the production gets depleted over time, here's what the net present value of those cash flows is going to be. Like I said, we're buying these at 20% net present value without any debt on it. And so we're buying that cash flow, and that's, there's some variability to that, right? If oil prices crash and, if there's higher CapEx needed, just like in anything, but it's a pretty good place to start. And then you can look at what's called so that's your kind of PDP, your proven developed producing wells. So they're proven, which is an actual SEC designation. Then you have your proven undeveloped location. So these are proven oil or gas reserves in the ground, but there's no well yet. And so to get the proven status is very difficult. It's a very, very high level of confidence that the basins and reservoirs are there. And then you can go do new drilling. And so we're doing infill drilling. We're reducing our risk by having the cash flow. So if one well doesn't hit, we're not, out of our money. And then these new wells in the basin we're in, they have a 90% success rate with a 50% gross IRR on average. And so you layer the kind of upside on that with the existing cash flows that you've already got, it can create a really nice recipe of strong cash flow plus some upside, and that's without even baking in higher oil prices over the longer time frame, because that's anyone's guess, right? We have a good case. It's kind of partly why we like this asset, to kind of have that exposure to the upside, but it still has to work in the here and now, right? And that's the important thing. So. Not to get kind of too technical on some of the things I just said, but that's really where we're seeing the opportunity is, buying the cash flows with some upside. You can take more risk. You get great tax benefits if you're just doing pure drilling programs, but you're taking a lot more risk. And I always say, never let the tax tail wag the dog, right? You don't want it just to invest in something because it's got good tax benefits. You want to invest in something because you believe it's a good investment. And hey, by the way, you get good tax benefits, which is how we're structuring it.
Yeah, I'm glad you brought up the topic of tax benefits, because it's one of the things that we've often heard about. Of course, real estate, and I've heard a lot about oil and gas, but I never knew how they work. But before we get into the tax benefits, Ben, how can people reach you if they need to get in touch with you or they want to invest in oil and gas with you?
Yeah, I mean, it's the simple way. Just go to our website, aspenfunds.us, and it's there on the homepage. We have a few different offerings available right now, and we're currently still raising for a fund. And you got to be an accredited investor, so that is kind of the one parameter. But yeah, it's available there. You can see all the data that I just talked about.
All right, let's jump into the tax benefits, because I know real estate, it's kind of you understand there's stuff like you can do the cost segregation studies, you can get bonus depreciation right now, or otherwise you get accelerated depreciation, and there's a whole lot of stuff in the tax code for real estate. But what about oil and gas? Like, how do you benefit in taxes? One of the challenges that especially high income earners, W-2 people face is that real estate a lot of times will not, especially if you're investing in multifamily, will not offset the active income tax that they're paying, right? So is that something that oil and gas can help them do?
Yeah, great question. So as someone who is a professional real estate investor who loves real estate, tax benefits are amazing. I just actually filed my final tax return for this last year, and it was a beautiful sight when you can take all these write-offs, right? But oil and gas, I would say, is as good, if not better, because it actually has some additional optionality. And so the kind of three biggest tax benefits you get in oil and gas: you get depreciation on like equipment and other things, but then you also have depletion expense, which is another kind of non-cash expense similar to depreciation that accounts for you're depleting the resource that's in the ground, right? So that's an IRS kind of benefit that they put in the tax code. And then the probably most compelling and powerful tax benefit are drilling expenses. So you have intangible drilling costs, intangible drilling costs. And so it's a pretty incredible tax write-off, or really tax deferral, because there's recapture, but you can write off almost 100% of your drilling costs in the year that you incur them. And so that's a very, very powerful thing that you can do. Now, depending on, you said active income versus passive income, it is possible in the right structure that those losses can actually be taken against active earned income, right? And that's something you can't do in real estate unless you're a real estate professional, which maybe a lot of your listeners might not be if they're, actively working. It can be difficult to do that, but if you invest generally as a general partner in a limited partnership, then you can potentially take those losses actively. So it is something that can be very, very compelling, especially if you're a high W-2 income earner, and something that you really need some extra help on the tax side. Something to consider. Now, again, I always say the caveat is be careful, because there are people that are touting these big deductions in their deals, but the deals themselves are sucky and just not good deals. So, don't let the tax tail wag the dog. But if you find a good deal, then look at the tax implications, and hopefully that'll be in your benefit.
Well, I mean, that's great to hear, but I just want to, add a caveat here. We're not CPAs, we're not tax professionals. So please, yes, folks, if you're listening to this, please talk to your CPAs about your tax deductions. With that being said, it's very encouraging to hear that, the deductions in oil and gas can actually help you, or there is at least something in the IRS code to help you offset against your active income. Even if you have a W-2 and you're not able to reach something like real estate professional status that we see in real estate, which is very difficult, especially for physicians who are working full time to achieve. Ben, let's just move on to, sort of for an investor, like somebody who's starting new into oil and gas. What advice would you give them in terms of, how to find these deals, number one, and really what are the right questions to ask the operators who are bringing these deals to them?
Yeah, absolutely. I think, it's just like anything when you're trying to find new operators, work through your network first. Because if you just go find someone online and, they're running an ad and you kind of talk with their, people on staff, it's not necessarily a bad thing, but you just have less information. You have less corroboration of, are these people legit or not, especially in this space. Like, you want to work with kind of trusted people that have been around a long time. Talk with some of their investors, talk with other people that have worked with them before. Again, I think so much of this comes down to, especially in real estate where track record matters, but it really matters in oil and gas. Expect more variability, right? Because it's a much more volatile market than real estate. So you got to understand, this is something. I've shared a case where I think there's upside, but I could be wrong, right? And oil could crash to $30 a barrel again. I mean, there's so many factors that go into this. So you want to understand, what are the downsides, what are the risks involved, and I think the kind of key risks are probably 3 or 4 primary ones. One is your operator, and not just what's the strategy, because there's different types of ways to structure this. The way that we're doing our investment strategy is investing in non-operated working interests. So we're actually going and investing in working interests, which give you the great tax benefits, but we're non-operators. And so we're actually partnered with large operators. So on this first deal, this is an example again, we have 8 operators, 6 of which are publicly traded companies. I mean, these are big time companies. And because of that, that adds it reduces a lot of risk from an operator standpoint, right? These are publicly traded companies, have huge teams, huge resources, been doing this a long time. So that's important. But then also, if you're not working with a large operator, ask about the track record, ask about all the deals that didn't go well, get an account of every single well they've ever drilled, right? And they should have that data. And you want to understand that. The other piece of this is the drilling. So drilling is probably second biggest risk. And so ask, is it exploratory drilling? Is this going into a new area that has not been very proven? It's kind of more exploratory. Well, not to say you shouldn't do those deals, but it's a much higher risk. So don't put as much likely into those types of deals, or really make sure the risk reward return is there. I think infill is a great kind of way to do this, where it's going into existing proven basins. Right now with the technology we have with geological 3D mapping, other things. Like there's a pretty good sense in these basins as they get drilled, all that data gets aggregated and kind of builds this pretty high probabilistic model for where the reserves are. There is some environmental risk. You've heard about the big oil spills and other things that have happened. That is always a risk, but generally I would say that most of the big incidents that kind of get the headline news, they're offshore drilling, right? These are, going in and not on the lower 48, on actual land. So that is a risk. And then commodity prices, that's another, again, just volatility that you got to think about in this. And so, you don't want to invest so much. You're taking huge risks, but you want to have something that, realize it's going to probably be a little more variable than real estate. But like in our fund, for example, we are employing a certain amount of hedging, commodity price hedging. And so ask your operator, are they hedging price? Meaning, are they pre-selling some of their future production at a fixed price? And by doing that, that just reduces some of that variability, right? So it reduces some of the upside, but also reduces some of the downside. So that's kind of the trade-off you're making. So those are the things you're doing. Never feel bad asking the hard questions. And if an operator's not willing to ask them or answer them, then move on. There's a lot of good operators out there. You don't need to waste your time with the bad ones. And just as an example, like just ask a lot of questions and just try and meet a lot of different people that are doing this already, because we were at a conference a month or two ago, and there were, oil and gas is getting a lot of headlines because people are seeing oil prices are going up, and real estate's kind of in a lockstep right now with this interest rates. So people are allocating more to it. But, we're talking with some of these operators, and they're basically selling these these shares in a single well drilling program. Okay, I understand that's something people can invest in. Me, I would not do that because it's too much risk. And then on top of that, they're upselling the cost of the actual tangible drilling costs by 4x. So it costs about, to drill a vertical well, say $600,000 to $800,000 as kind of a range of cost to drill and complete a well. It's vertical. Horizontal, it's going to be a lot more. It's going to be $3 to $5 million. But vertical, what a lot of people are doing. And they were selling the interest in the partnership for $4 million. So basically what they're doing is they're taking a massive amount of fees up front. They're diluting the value of this well. And then say the well does hit, but it's only producing a few barrels a day or something. Well, because they've upsold the deal so much, your return is going to be terrible. And then if they don't hit, your return is going to be zero because you have one well. So you just got to, again, understand what you're investing in, get diversification, and get track record of all the past deals they've done.
Very cool, very cool. Any final words, Ben, before we end this session? This has been so amazing.
Yeah, no, I mean, I think again, it's something that just like anything, if you're kind of new to it, take it slow, right? I mean, I think now is a great time. So I would say, accelerate some of your learning, but don't ever invest in something you don't feel comfortable with, right? I mean, this is just basic, investor 101 type stuff, but it's hard to not get swept up and, you see a deal you like and you just kind of jump in it. And, there's a lot of people that I've talked with that got burned and they don't want to invest anymore. But I'm like, I know, I get it, but this is different. Like what we're doing is a different type of deal. And I think people just it leaves a bad taste in their mouth. And I think just by going a little bit slower, by just doing some basic, due diligence steps, you can alleviate a lot of the kind of bigger risks or obvious risks, and then just be smart about it, right? Just don't take outsized risks, even if the returns being projected are really, really high. Don't take outsized risks, right? Use a balanced portfolio approach of, this is just one allocation across your broader portfolio that you can allocate to get some diversification from, say, heavy real estate or whatever you're heavier into. So.
Yeah, I agree with that. A lot of times you see something and you see it's very lucrative in returns, and all of a sudden you have this fear of missing out with FOMO and you want to invest in that. But I think doing your due diligence before investing in anything is super, super important. And that's why even though oil and gas seems so lucrative to me. I'm still focused on multifamily. Believe me, it's like, oh man, maybe this is the next best thing. But pausing and looking at what you have and what you want to build on is super important. And I believe that there's money to be made in every asset class, but you need to focus on one and learn it pretty well so that you can have the advantage that the others may not have in that asset class.
Yeah, I mean, going back to Warren Buffett, one of his things is only invest in what you understand, only invest in what you know, and I think that's a pretty simple, framework, but it'll probably keep you from a lot of stupid stuff, right? If you don't understand, if you can't describe it and explain it to a 3-year-old, and you have really high level confidence of what all the risk factors are and how it impacts, just don't do it. There's always going to be another good deal. There's always going to be, another thing you can do, and it's something that you want to make sure you understand what you're doing. But again, that also doesn't. I would say I put the impetus back on investors, because the natural thing is, well, I'm just going to rely on an advisor. I'm just going to rely on someone to tell me what to do. But that's just as bad of a situation as, because you still don't understand it, right? You're still investing in something you don't know, and you're offloading the responsibility. I think something I say all the time on our podcast is, you work so hard to build your career. You go to school. I mean, how many years have you been in school, Avishkar, right? And
gosh, it's forever, man.
Because you're going to be able to make a really good income over time, and you work so hard to make the money you make. But then you spend almost zero time thinking about how to preserve, how to grow, how to multiply what you've already been earning. You work so hard for. And so I would say work as hard, if not harder, multiplying your money as you do earning your money, because once you have a little bit of cash, it's so much easier to grow from that point, right? But you have to do it intentionally. And so again, I always say, put the impetus back on yourself of taking responsibility for learning these things, because if you're smart enough to go to school to become a doctor, you're definitely smart enough to understand real estate, understand oil and gas, understand just the basics, right? Of just how to find good partners, how to find good deals, how to build a nice portfolio. Like, there's so many resources out there. You can do it, right? So just don't overly rely on people that are selling something that have a different, maybe have a conflict of interest, or have just a different set of goals that don't match what you're trying to do.
Yeah, and you know what? Doing nothing is also doing something. So if you're not doing something, so you're still making a decision, and something is still happening based on that decision. So we'll end with that. Thank you so much, Ben, for... All right, guys, if you haven't done already, please go check out my free video series on how to do due diligence on operators and on deals before investing in them. It's called Real Estate RX for Passive Investors, and it's available at www.rerxcourse.com.